Hello and welcome to this annual update for the China Growth Trust. I'm Sophie Earnshaw, one of the managers of the Trust, alongside Linda Lin. In this short update, I'll talk a bit about performance, provide an update on what we've been doing in the portfolio, and leave you with our outlook on China and how the Trust is positioned. The portfolio's performance in 2023 was disappointing in both absolute and relative terms. It underperformed against a falling benchmark. Stock markets were impacted by a mix of challenges, including domestic economic difficulties, as well as rising geopolitical and regulatory risks. A lack of confidence in the domestic markets has led local investors to seek stability in sectors such as energy, financials, and utilities, which perform strongest. These sectors are often state-dominated and offer very little growth, which is why they have limited representation in the Trust's portfolio. Not owning them was one cause of our underperformance. At the stock level, we were hit by weakness in various consumer and construction names, including local sportswear brand Li Ning, which saw growth and profits hurt by the slower consumption environment, which led to inventory write-downs. Beijing United, which had a concern about revenue recognition that led to regulatory investigations, and Glodon, a leading construction software company whose end markets were hit by weakness in property. This has now been sold. This was partially offset by stock-specific strength at ByteDance, the largest holding and the only private company in the Trust. Though this company has challenges with TikTok in the US, it is both very cheap and growing quickly. We also saw relative strength at engine maker Weichai Power and BMW's onshore JV partner, Brilliance Auto. It's fair to say that the extent of the drawdown and the persistence of negative sentiment and weak confidence has surprised us all, though we've recently begun to see signs of optimism return. The authorities stepped in with a raft of policy measures aimed at shoring up sentiment prior to Chinese New Year, which led to more recent rebound in stock markets. That's a helpful start, but we still think that the sustainability of any recovery is dependent on further stimulus and reforms. While we understand that poor performance has been painful, we can offer a degree of encouragement based on what the portfolio has actually been doing. A return to fundamentals shows that the environment for growth and innovation in China remains strong. While headline GDP continues to slow, there are ample structural opportunities in a variety of industries that continue to excite us. Indeed, because of our ability to avoid vast swathes of the index, our portfolio holdings delivered double-digit earnings growth in 2023, despite China's economic woes. As examples from the Trust's portfolio, e-commerce company PDD reported revenue and earnings growth of 90% in 2023. CATL, the world's leading battery manufacturer, reported 44% growth. Anker Innovations, best known for their wireless charging devices, grew 55%. But given the macro environment that China has been through, valuations have come down. China is now at valuation levels that are as low as we've seen in decades, both in absolute and relative terms. So the starting point from here is that we have a portfolio of companies that, in the main, are performing very well and are now on far lower valuations than we've seen for years. As a result of market volatility, operational developments, and low valuations, we've recently seen a pickup in transactions as we look to take advantage of various opportunities. We've been able to make additions to companies whose valuations have fallen despite them reporting strong growth, companies like CATL, Meituan, and Tencent. We've also made a new purchase of Luckin Coffee, where new management has built a strong mass-market brand, but whose valuation reflects its history, not its future. And Shanxi Fenzhou, a regional baijiu brand. Baijiu is a white spirit, with scope for further development. We believe the overall shape of the portfolio is exposed to a more positive macroeconomic scenario via overweight positions in both consumer discretionary and industrials. At the margin, we've been reducing our exposure to e-commerce, given slowing industry-level growth and intense competition. We've also sold holdings in pharma contract research and development organizations WuXi AppTec and ASIMChem Laboratories, which have been hurt by a bill being debated in Congress that could significantly reduce their ability to win future contracts in the US. There's clearly a groundswell of noise around US protectionism and national security concerns in areas ranging from TikTok to genetic data to electric vehicles to Chinese-built cranes in ports. We should expect continued pressure given the elections this year, particularly when related to technology and national security. However, we should also recognise that the vast bulk of the portfolio is focused on China's domestic revenue opportunity. This opportunity remains very significant, and the companies exposed to it on very low valuations. China's economy continues to transition away from its old model of property-led growth to a new model of innovation-led growth. There is clearly a risk that the government fails to manage this transition successfully. However, we are cautiously optimistic. Policy support to stabilise the property sector continues to build. Any improvement here could be very meaningful for consumer confidence and domestic demand. In addition, the government continues to offer support to the new productive forces that are vital for the country's long-term transition. Areas such as new materials, the climate transition, and industrial automation. Both domestic demand and new productive forces are well represented in the trust. Looking forward, we're encouraged by the operational growth exhibited by companies held in the trust and by the government's growing support for the economy. While we acknowledge that geopolitics is likely to remain a long-term headwind, we believe very low relative and absolute valuations compensate us for this risk. As such, we continue to be excited by the opportunities that China presents for long-term, patient investors.